Hi, guys. It's Chad Larson with MLD Wealth. This is May's episode of Money Matters. Lots to unpack. I'm going to spend maybe 10 minutes or so buckle in and enjoy my deep voice, I guess, for a little bit. I do these every month, and the intention of it is to really discuss not so much. I'm not going to run through what the interest rates, the 5-year bond rates, or how much the S&P went up, and get granular and nerdy with a bunch of technical data. It's really to set the table and set the tone for where we see the market going, what we've seen over the last kind of month, what are our positioning strategies, and how we're positioning our capital, and really give some insight into thematics in the marketplace that we're seeing now. Over the last number of months and episodes, we've gone through a number of topics, high level thematics that we see constructive through 2024 and setting up for bull markets, things like copper and gold and energy, and a more balanced approach to the market, taking an equal weight approach to the S&P versus that of a market weight. But I kind of wanted to set the table and answer the question of why the roller coaster 2020s are set to end with a roar. We look at the market since the start of 2020 to now. We've gone through quite a bit. Largely it was COVID. It's been a bit of a roller coaster, and it's only been in the last part of the year where we're not even kind of back to where we were. I think maybe just touched on to our market peak from back in 2021. So here we are, almost midway through 2024, and almost thus far been a decade of nothing. I did talk a lot last month about, aside from understanding it was a very narrow market last year where the top 10 companies occupied over 100% of the earnings per share growth of the entire S&P. The Magnificent Seven and their three closest cousins did all the lifting, but we're starting to see a bit of more broader recovery into the market, which is great. But the technology stocks lit the fuse for what we see as a very, very constructive upcoming year. Off the back of of a plus 33 in the S&P, I always just remind people the year before that, 2022, the S&P was down almost 20%. So if you have $100 and you turn it into 80, you need 30% to get back to go. So it's been 2 years of nil returns in the S&P. Meanwhile, and this was calendar year over calendar year. Now we have had a constructive market into the front part of this year. Obviously, this month, which I'll get into, has hit a pocket of volatility, which we were expectant of and we're positioned for. But we've seen 10% earnings per share growth over the last 2 years. So market hasn't really returned much. It's been highly concentrated into a small subset, select amount of companies, but the overall economy is improving. And as we see a more synchronized global economic recovery through 2025, I believe the market is starting to pay attention and starting to pay forward in anticipation of that. Now, the market started this year with the anticipation of 6 interest rate cuts. The Fed signaled they were done hiking interest rates, and this was going to be, a time when fiscal policy and monetary policy would be in line with increasing money supply or access to capital, and that bodes well. Never fight the Fed, but when money becomes easy, the market generally does very well. Now it looks like I said 2 months ago, I think the market was a little ahead of itself and a little bit over its skis in thinking there was going to be 6 cuts. It does look like we're higher for longer, but that's not a bad thing. Just remember, this will absolutely ensure that we don't have nascent or late fuse inflation sneaking back into the market. The longer they stay higher, it ensures the other side of the inflation curve is very healthy on the other side. And the longer you coil at the top and pause, actually bodes very well for the economy on the other end. So, aside from, a lot of people, in the economy struggling with mortgage renewals in Canada, like that is an absolute problem. We have been saying we are more constructive into the US market this year for sure. The Canadian economy is far more in a worse position to navigate higher for longer. But okay, so why are the roller coaster 20s? Why are they set to end with a roar? So we saw the roaring 20s, off the back of, the Great Depression and, et cetera, et cetera. And it was a time of, the Great Gatsby and a boom within the economy. And now we have the roller coaster 2020s. Like this is This is the world of Taylor Swift, Tesla, robotics, ChatGPT, and Ozempic. This is just a very different world than in 2020 when we had the Model T, the radio, and the early telephones. How the world has changed, but within the macroeconomic environment that we see, we always look to the forecasters and the economists, but forecasting is hard. What experts thought would happen versus what actually happened, changes, through, when I look at the S&P 500 sell side strategists, beginning of the year consensus forecast versus actual, the divergence or the difference between them is very wild. And I'm talking like more than 10% per year. In 2019, the forecast was for 19%. Market did 29. In 2020, they thought it would do 3. It did 16. In 2021, they thought it would do 7. It did 27. In 2022, thought it would do 4. It did minus 20. So all we know is that forecasting is tough, and we have to look at economic data between what has actually happened and how it pairs. But just remember, the market starts to trade based on the probability of forecasts becoming true. Listen, we've talked about this recession being, we've been 3 months away from a recession for almost 2 years. A fight between, I guess what the actual definition of is of a recession, vis-a-vis the soft landing that everyone is expecting. But the Fed estimates of GDP now versus the consensuses are a little bit in line, and it looks like the forecast last year was 0.3% GDP growth, and we actually saw 2.5. So looks like we're going to get out of this okay. And I'm talking in the U.S. Well-behaved jobs and wage data. Employment growth is stabilizing at a lower level, but still growing at a pace above pre-pandemic average, about 190,000 jobs per month. And wage inflation is moderating. So, that's great. Again, Canada is a total mess because of our immigration policy, and that is, a whole nother conversation and probably not recorded. But we continue to see great things happening in the U.S. Deflationary trend is intact. Core goods, headline goods, housing and services. Housing and services remaining a little bit high, but core goods, year over year are coming down. So we've seen the 10-year real interest rate. Obviously, it spiked after 2020, but still historically, going back to the early 80s, we're in line. I saw an interesting chart the other day, and it was spurred from a conversation of someone close to me, kind of talking about, having to renew a mortgage into a higher interest rate environment, and mortgage was going to be like 6%, and that was terrible. And their existing mortgages at like 2.5%. And, how could this ever be? If you took the average mortgage rate from 1980 to today in Canada and gave them, an equal weight, the average mortgage and rate per annum in Canada since 1980 is over 7.4%. Through the 80s and 90s, there's some incredible years, obviously, of super high rates. And it's only been in this microcosm, probably more part of my adult life where we've seen these, historical low interest rates that people become very comfortable with. But I digress. Goods and services, U.S. service spending has been very resilient. The U.S. real person consumption expenditure on services, obviously through 2020, in the COVID, went to near zero, but back on trend. People are spending money. People are buying stuff they don't need. It is a consumer-based economy. Global growth is improving. And, we spend so much time looking, introspectively within our own core market or within the S&P, but the world's a very big place. I always proxy my discussions around the U.S. economy. There's no bigger market. It's 52% of all global GDP activity is originated in the U.S. It is the superpower, but it's still only 52%. There are things happening all over the world that matter. So the OECD G20 composite leading indicator is very positive. New orders are picking up globally. Things are starting to happen. Into 2025, when we see what I'm calling a synchronized global economic recovery, that's that roller coaster is going to end with a roar. I think we're going to see a very strong bull market. Last year wasn't a bull market; it was a recovery. And we're really starting to see the economy pick up. So global demographics trends, they remain a little bit mixed. North America demographics being most favorable. China is going to be a problem. Big economic power, but working age population is beginning to decline. Struggling with, when you look at their one child policy, you look at the kind of number of births in China going back all the way to 1950, through the Great Famine, through the 60s. But in 1980, when they indicated the one child policy, which ended, a number of years ago, that nascent amount of, how the nuclear family is structured and how people just start to think and believe what a family unit is, even though one child policy is gone, after 30, 40 years of one child, culturally, it's just you're not seeing larger families. So you're seeing the working age population really starting to decline in China, and that will have an impact globally. Within the stock market, it's talking about earnings per share growth of 10% per annum over the last 2 years, at a business line level. I'm not talking about the market or stock performance, but the S&P has the most direct correlation to the direction of earnings per share. So the market tracks earnings. Yes, there is fear and greed and sentiment and multiple expansion and all sorts of, the closer you get to the chart, the wilder it looks. But the stock market is a proxy to economic activity and earnings per share growth. So if we're constructive to see earnings per share growth within the economy, we should be constructive to own equities. The S&P earnings growth to return in 2024. If we look through 2023, the actual numbers, aside from consensus of where everyone saw it, the market performed better. We were expecting Q3 of last year to have 0% earnings per share growth, and we saw 5. Q4 we saw 3. But the consensus through 2024, and we're seeing, we're live in earnings season right now. We're seeing strong earnings. We see consensus through each quarter of 2024 of 6, 11, 8, and 18%. Going into the end of this year, you're going to see, we feel, a high probability and strong conviction of very strong earnings per share growth with easing money supply. So yes, we have been deploying capital selectively and getting portfolios positioned. I was very clear. We positioned portfolios and reduced market cap weighted and went to an equal weight exposure to the market to reduce our exposure to some of the technology companies that have just treated us too good almost. And I'm really happy to do that because the market did absolutely hit a bit of a vacuum and hit that bump. And just remember, pockets of error are normal within the flight journey of the stock market. Almost every year, there's a 10% peak to trough trade sell down within the market. These are normal. They're healthy. They allow us to deploy capital. But again, economy is improving. All I can get past you time and time again, the economy is improving. We see a synchronized global recovery through 2025. Fed has done hiking. Yes, they're holding in stronger to make sure that inflation doesn't flare back up. But again, the amount of cash on the sidelines is absolutely mind-numbing. Estimates of interest income generated by money market funds alone, so on a monthly basis, is almost $300 billion. Sorry, on an annual basis, $300 billion of interest being generated just in simple interest on money market funds. We have now seen, I'm looking here, total financial assets of money market funds. These are held on books and systems like ours across, the North America, is almost $6 trillion. Assets in money market funds and cash deposits or CDs, that when you add in time deposits on top of money market, we almost have $9 trillion of cash on the sidelines. Yes, they are earning money market rates of return around 5%, and that's awesome. That is that risk-free rate of return. As those rates start to come down, it's less attractive to own. You see that money start to come back into equities. And again, I mentioned this last month, any super conservative investor that's hiding in GICs right now, duration is probably your friend, and you should be looking at extending out your duration because the short end of the curve will obviously change the fastest. This end of Fed rate hike is very positive for equities. Now, there's dispersion to that, and we can go back and talk about, from last hike to first cut, 1974, 1980, 81, 84, 89, and on and on and on. And I'm happy to send any of you these data points to look at and plot chats. But, from the first last hike date and first cut date, you've generally see the short ones And what I mean, let me spend time there because I don't want to blaze over this. The longer between the last hike date and the first cut date bodes very well. So I'm going to give you a subset of the market. So in times where between the last hike and the cut, when it was small, like 29 days, 24 days, 61 days, during that pause, the market did terrible. But in the times where the Fed stopped hiking but didn't cut, that kind of higher for longer, 100 days, 150, 200 days, 440 days, the S&P return during those Fed pauses is very bullish. So the S&P 500 usually higher 12 months after the last rate hike, and longer pauses are associated with strong equity like returns. So this is all very good. Why we were constructive after 2022 was that after a bad year, things are a good year. That played itself out comparatively. And year two, not as good. I don't see 33, but we see strong returns this year. And then 2025 being strength begets strength. A strong start to the year, which we saw in January, February, tends to see strong continued gains throughout the rest of the year. We've talked about in volatility going into the election. So there's that U.S. economic policy uncertainty index. Obviously, that spikes going into the election. But the S&P volatility in election years since 1928 tends to start rising in July and peak towards November. Now, this month, we did see a spike in volatility, and that's on a little bit of overexuberance in expected interest rate cuts, as well as geopolitical concerns continuing to rock the markets. But again, equities are mostly up in election years. 75 years of U.S. bull markets, looking at their duration, the amount they appreciate, and what happens in year two of a gain, I can tell you things are setting up really well, and we're feeling very good. Market concentration, we've talked about the Magnificent Seven transitioning to the good, the bad, the ugly. Obviously, this things like Tesla have fallen away. Apple's struggling a little bit. It's just Meta and Nvidia are the kings, and Amazon are the kings right now, with Google and kind of Microsoft holding in their own. But again, the top 10 companies still represent almost 40% of the market cap, and that's incredible. So, but if we look at the average S&P stock being not expensive, median trailing price to earnings is significantly lower than the overall market. There is value. So we've talked about in past podcasts and updates about today's longer term growth opportunities. That deglobalization trade that's kind of been going on creates at-home opportunities for security of supply of critical minerals and base metals and energy, etc. Sustainability, I won't spend a bunch of time there, but regardless, there is fund flow there. Health and wellness is going to be massive. I think the next Jeff Bezos or Mark Zuckerberg, they're not going to be another app or another delivery service, but there'll be someone that's changed the world with respect to longevity and quality of life. And then the big one to talk about is robotics and AI. I think innovation drives GDP growth. Now, we're not all going to just invest in a pile of AI stocks and get crypto rich. The odds and probabilities of success of A, finding them, and B, them becoming actual commercially viable businesses is probably going to be even harder than biotech investing. But AI is here. And it is already working. It is learning fast. And I look at like the GDP growth multiplier by century. And this is going back to the year 1000. This is real GDP in trillions of dollars on a logarithmic scale. Nothing really happened from the year 1000 until about 1450. And then the printing press happened. Okay, so that entire kind of 450 years, the only thing that ever happened was the printing press. So we had a GDP multiplier of about 0.4%. From the printing press up until the steam engine in the mid 1700s, you had kind of one turn of GDP growth multiplier through technological revolution. And then things take off. And now the chart starts to look like the Nike swoosh. And that's things like the telegraph, electrification, mass steel production, mass production and assembly lines, the internal combustion engine, flight, synthetic fertilizer, transistors, PCs, internet, smartphone, cloud, and now AI. I will never be replaced by AI. I will absolutely be replaced by someone who is not using AI. Just had an incredible summer student, an intern, actually start today, and his entire project within my team is with very small amount of experience, if any, in financial services. His job is to observe our processes, and his job is to look at our pain points and watch what we're doing and think critically and think creatively about how we can create scale, how we can remove redundancies, how we can create efficiencies. I hired him because when he came into the interview, he knew more about me than I knew about myself. He had gone and transcribed every single podcast, every single press release, every single article I'd ever written, and taught an AI engine. I believe he used Microsoft's, but he taught it to think like me and to ask questions about me. And like the questions that he had for me were questions that I had been pondering and thinking about. Like his acceleration into hitting the ground running within our first interview, I knew right then and there. And it wasn't because he was lazy and he was looking for the hack, it's because he was thinking differently. And so I think when it doesn't matter if you're an AI company, it's going to be Johnson and Johnson, it's going to be GE, these boring companies. I don't care if you're making, fence posts. They're going to use companies that are going to be using competitive AI to enhance their procurement methods, to enhance and create efficiencies in around their billing cycles. It's going to all translate into margin. It's going to all translate into more revenue per employee, more productivity per employee. It's going to drive earnings, which will drive earnings per share, which are going to drive markets. We're going to enter into this boon of the world. Yes, there are going to be major disasters through this. And I don't know the unintended consequences. If anyone knows, I think it's quite funny is my home network is called Cyberdyne Systems. And it's an homage or a poke at the Terminator movies. Like, yeah, we're going to get taken over by learning machines, but that's okay. Because we're not stopping it. I can tell you that for free. And never underestimate the size of new markets. On average, Wall Street underestimates the size of all markets. I go back from 1996 and look at the PC, internet, mobile, the cloud. On average, Wall Street has underestimated, the actual adoption of them by 38 to 40%. They originally thought in 1996 there'd be 225 million users of the PC. By the year 2000, there was 350. These numbers go on and on. They thought 650 million smartphones would be out in the market by 2013. There was well over a billion. Cloud providers, they thought it would be 90 billion. It's well over 115 billion in the same year. So we do believe that this is an area of the market, albeit tough to invest in, but I believe the entire economy and the entire world will become better as a part of that. So, within that, all I kind of wanted to say is like when we look at our high conviction portfolios, when we look at our pragmatism and how we're constructing portfolios and positioning capital, we want to look at the right, economies, the right stage of the economy or phase of the economic cycle. We want to make sure that we get our sectors right. We want to make sure that we have a high IQ, and that IQ, aside from intelligent quotient, truly is implementation. We all know how to do things. Whether we do them or not is what I think separates. It's the doers, thinkers and dreamers and doers, and yeah, everyone's in a different place. But having, I'm so blessed to have the incredible client families and that I call private clients that make up our business that I care deeply about. But I'm equally as proud and thankful for the team that I've assembled. We're over 10 people deep. I've been doing this June. It's June 20th. If anyone wants to send me a card, June 20th, 22nd of this year will mark my 20th anniversary being in partnership with Curtis Mayer. And, you don't make partners like that. I shook his hand over 20 years ago, and we set out to build the preeminent. We've always reinvented ourselves. We've always pushed ourselves every day to improve, develop, to change, to skate where the puck is going. Like all the analogies, we've vested heavily in our people, our process, and we've stayed true to our philosophy. And I couldn't be more excited about the next phase of the market. Just an absolute incredible group of people, and very thankful to come to work every day with such an amazing group of clients. With that, I wish everybody all the best through this month. Have fun, do something cool. I want to hear about it. And I look forward to seeing and speaking and communicating. As always, MLD is here for you. If something you want, if something's important to you, it's important to us. Please reach out to us. There's no such thing as a dumb question, and we look forward to seeing you guys over the next coming bit. Have a wonderful month, and we'll talk soon.